Welcome to the daily update, where I'll go over the action in the market for Tuesday, June 25th, and then we'll see how things look for Wednesday, June 26th. Had an update with the S&P, saw a little bit of late day strength. Unfortunately, the internal strength that we've been seeing building over Friday and Monday, even though the S&P didn't do all that much, the internals were looking better. Well, we have an update with the S&P, and the internals are back to looking worse again. And that's a little bit of a concern. So we're still positive for right now on all the different time frames, but we're looking a bit vulnerable. However, to see late day buying coming into the market is always encouraging, because that means that the smart money is coming in and actually doing some buying. The smart money indicators are turning back up, but some of the other indicators that were improving are now starting to show some more weakness. Before I get started, the SPXInvesting Program has launched. It's free for the month of June. I'm going to be locking that down in July. If you want to learn more about the program, there is a link to go to a playlist on YouTube, and I have some videos on Rumble that you're more than welcome to check out. There's also a link where you can go to the website itself and just look around. I'm going to be bringing out a lot more things after I lock things down. The June was more just to kind of get things established, make sure everything's working okay. And there's going to be a lot more content and things like that for you to be able to use and just analyze things and see if it's helpful to you. Let's go back and talk about what happened, and then I'll look at some charts here. Right at the open, we had a higher open. Futures were doing okay, not great, but still positive. Prices tried to climb above the daily pivot at 54.62, but fell back down to the unchanged level. Then we climbed back above the unchanged level after going negative for a while, but we didn't get up to R1 at 54.76, and we closed slightly below 54.70. We were at 54.69 and change. We were up 0.39%, and volume has still been fairly healthy. Now we're coming up to the end of June, where we often see some positive seasonality after we get through kind of a few bumpy days along the way. But this is going to be the end of the week, it's going to be the end of the month, and it's also going to be the end of the quarter. And so there could be some window dressing going on. There could be, because money managers and hedge funds and all that, they want to look good because they're going to have to send out quarterly reports, and they might be getting rid of some bad stocks and buying into some stocks that have been doing well just so that they can show that in their reports. So there could be some gyration according to that. And maybe that's why volume continues to be above average, even though we're not seeing an awful lot of movement in the indexes per se. We are still positive on all the different time frames, and we're going to get a big inflation report on Friday, the core PCE. In Thursday's session, we are going to get GDP, but we've seen that before. It's just going to be, are there big changes based on what we've seen in the past? And there's an inflation component there as well. And some comments: mega caps, semis, and growth. These were the ones that really led things higher. They did better and rebounded after seeing some profit taking than the broad market. And so the broad market, which was giving us a little bit of hope that maybe things were improving in the bigger picture, that's kind of falling back now as the mega caps came back in Tuesday's session and really did better. The negative divergences are not going away. It looked like they were improving. Now it looks like maybe they're not improving. On a short-term basis, we just have one indicator right now. The Williams percent R has gone barely extreme positive. Our stochastics remains extreme positive. And then I guess we have three here. And then we have our RSI, which had just been extreme, dropped back down, and now has gone back up to an extreme reading in the short term. That's based on 9 periods. We don't have anything right now in the intermediate term. And we're still going with this same scenario. The Fed's going to leave rates higher for longer because inflation hasn't been really coming down. And if we're going to get a rate cut, the market is anticipating that it will be in September, and it looks like we may only get one rate cut, at least right now. There's others saying that we're not going to get any, and some are actually projecting now out into 2025 before we actually see a rate cut. The dollar was up and interest rates were down, so a little bit of a mixed picture there. We closed at 4.24% for the 10-year yield, where we had been at 4.25%. We're still inverted with the yield curves. We're actually ticking down a little bit on an up day. This is part of these negative divergences coming back in. We were at 39, which is still negative, where we had been at 40, which was also negative, but we're ticking down even on an up day. We are in a confirmed trend. We're above the moving average. We're going up. The green line's on top, but it's still coming down. So we're seeing a little bit of contradiction there. We are positive with the slight up day that we had after having a couple of down days. And I'm keeping our momentum at mixed right now because the market's not really doing all that much these days. The economic reports that came out, we got the I can't ever say this, FHFA Housing Price Index. It came in up 0.2%. Last time it was up 0.1%. The Case-Shiller home price came in at 7.2%, more than the 6.9% they expected, and down from the 7.5% we saw last time. This was a little bit of a concern where it came in higher than expected for consumer confidence. They expected it to come in at 100. It was at 100.4, but it ticked down from the 101.3 that we saw last time. So here's a chart showing a month over month of the housing prices are actually going up. After they were really spiking up, they came down, but now they're continuing to go back up. Here's the Case-Shiller home price index. This is year over year, where it shows them actually declining a little bit, but still positive. And here's looking at consumer confidence. The total, that's the reading that we're getting right now. That's the blue line, and it's pretty much in the middle. And then looking at how people are feeling right now in the present, that's the purple line. A little bit of an improvement there, and actually a little bit of a decline when people are looking out into the future. Some Isabel Net blog charts. This is the technical overbought, oversold composite. We're coming in at 87.42. That's still a high reading, but down just a little bit from some of these really extreme readings. If we get another up thrust here, it's going to kick this up even more and put us into an overbought type of situation. And this is a weekly chart of the NASDAQ. Now, most of my focus is on the S&P, but it does help us to look at other markets. And we're keying off of that right now, off the NASDAQ, especially when it comes to pivot points, where you can see here they have a cup and handle, which tends to be positive. We've been able to go back and set new all-time highs. And these are just some projections looking forward as to what may happen there. And they have one count at 18,700, another one at 22,400. We'll have to see if we do start to experience some weakness in the market. It's like these are all going to get shifted around and pointing down, but for right now, everything is still remaining positive. And then looking at the 10-year yield, this is also a weekly chart. We have been watching this quite a bit, but we have some Elliott waves on here. And again, I'm not a big Elliott wave fan because it's so subjective, but this does suggest that interest rates could continue to fall, and that would give more support to stocks. We also see the different oscillators down below, which are, for the most part, still continuing to decline. Consolidated equity positioning, still going up as folks are getting more into the market, but not necessarily at an extreme reading, according to this chart. And then the sector fund flows, everybody's just loving tech right now. Money's just dumping in there hand over fist, almost mania type of reaction to what's already happened. And so that may give some support for a little while, but it could also end up being negative in the longer term, because when everybody starts to do something, that's just about the time the party is over. So we'll have to see if earnings and the technical picture and things like that, and economic reports, if that can support stocks still going higher. There's a lot of things to suggest that things are going to turn quite negative in the 6 to 12 month window, but we don't know that yet. We've seen those types of things before, only have it not really play out that way. There's warning signs that we're keeping an eye on, but we have to watch it day by day by day and then see these things as they actually develop, because they don't necessarily happen instantaneously. There are clues that are given off before we start to see a shift. And yeah, we're potentially seeing signs of a shift right now, but now we're not seeing it based on price. We just have to see some more follow through with that. And looking at this chart, they don't, the 53% that were surveyed here, do not expect a recession in the next 18 months. And that's actually declined a little bit, but it's still in the lead. Then there's folks that think we're going to hit one in the first half of 2025, second half of 2025, and then down here at the bottom, the second half of 2024, which we're now getting ready to go into. So in the nearer term, folks are not necessarily as fearful about a recession, a little more fearful going out into the future. And sometime over the next 18 months, they think that we might hit a recession. And we will at some point. That's part of the economy. And things will get to that point somewhere along the line. We just don't really know when. We've already been watching this for a couple of years now, and there's this debate going back and forth, things that could suggest that we will go into a recession, other things that suggest we will not. And then small cap stocks are at a record low versus the NASDAQ 100. If you watch any of the weekly videos and the what to watch video, where I do a ratio between the NASDAQ 100 and the small caps, this chart would be just reversed. We're actually breaking above. These are previous levels. And this continues to go down, meaning small caps are really underperforming. There's some folks out there that are more positive on the small caps. Now, again, this is not an index I trade. I just watch this to see how the market is acting. But I wouldn't even consider doing it personally until we break out of the range that we've been in for the last 6 months. So until something like that happens, we tend to get to the top of that range and then come back down. We get to the bottom of that range and then we come back up. And then the short interest. Now, this is a little different way of measuring it than what we've been looking at before. This is our folks or hedge funds or institutions that are actually shorting the market directly. And it's a percent of the share of shares outstanding. So it's calculated a little bit different. And this is up 2.25%, maybe 2.3%, getting kind of close there. Not very high overall. As we've been going up, we see short interest going down. We are seeing this picking up just a little bit. Now, that could be the negative sign, is that folks that do this tend to know what's going on in the market, but they're not always right. And so when they're wrong and we start going up, these folks have to end up covering those positions and they have to buy to get out. And this builds in some buyers on the sideline. And that's when we get a short squeeze or a short cover rally, when those things can't happen. Risk appetite indicator coming down quite a bit. Folks aren't really feeling as risky right now, as the market looks a little toppy, but still in an uptrend for the time being. And the corporate buybacks and dividends, where buybacks are really what is supporting stock prices going up as far as that part of the market, when companies come in and buy back their own stocks. Now, a lot of people get into stocks to get the dividends, and that is increasing. That's the light blue bar here, but it's underperforming the buybacks that we're seeing. So the buybacks help capital gains, where the dividends help provide income. And a lot of these companies, I guess, are focusing on the idea that we want to see capital gains in our stock rather than sharing our profits with our shareholders. I didn't find anything interesting on Twitter. And then looking at our intraday chart, we did have a lower open here. We were underneath the daily pivot. We tried to get above it, but then just kind of sat above it for a while. We came down to the unchanged level, which was yesterday's low. And then this is where we saw some strength coming back in, where we came back up above the daily pivot. We never made it up to R1, and then we closed not at the high, but a little bit off of the intraday high. Intraday, not really seeing anything all that interesting. The futures have been really subdued as of late, and then that kind of has been carrying over into the cash session, and we're virtually unchanged in the initial overnight session. And we're still looking better here. See, this is what we're seeing. We're seeing growth starting to look a little bit better, but some of the other internal measures that we've been watching that were improving are now starting to not show signs of improvement. So the blue line is on top and going up, where growth had a pretty good day and value ended up declining. So this is positive on it in when we look at the intraday chart basis. And when we look at the growth to value ratio for the S&P, also had a pretty solid update. So that is encouraging. And we were up 1.25% with growth, where value was down. We were down less with the mid caps and down less with the small caps. So it was a fairly good day for growth. So we're seeing a slight improvement with our end of day charts. Even the small caps ticked up slightly. The mid caps were able to tick up a little bit, and the S&P growth to value ratio did advance. And we're going back up again here when we look at the growth versus value ETFs. We're above the rainbow. We came right down to the top of the rainbow, and now we're bouncing back up. And we're just kind of going sideways here with discretionary. We saw a little bit of a bounce and then a pullback with the staples. So we're not seeing much of a change and not really much of a breakout here with our ratio between the two. We want to see this going up to be more positive. Large cap growth was up 1.26%, coming off of a recent all-time high after we saw a couple of days of weakness. And we're coming down a little bit here with when we compare large caps to small caps with the ratio. It was actually down a little bit after it had been climbing to all-time highs. The Wilshire is still hanging out right around recent all-time highs. In our trend, we are positive, but on an up day, we want to see this green line going up, not going down. But the trend is confirmed since it's above its moving average, and both the moving average and the ADX are above 20. And we're also declining here in the short term with the green line going down, but we have a confirmed trend, but it's still positive since we are above 20 and above the moving average. And volume is still above average, even though it fell down. It's kind of hard not to fall down after the triple or quadruple witching we saw last Friday. So that's why this oscillator is declining. But when we're above zero, that means we're also above average. We're ticking back up just a little bit with the Ulcer Index, but still well below the moving average. We don't have the latest reading from Investors Intelligence yet. We ticked down on a closing basis with the VIX on the line chart, and we're dropping back below the moving averages. And we closed kind of near the bottom when we look at the bar chart, where we saw a lot of the fear coming out of the market, and we're still getting very low readings for the VIX. And with the update, we did decline with the bar chart as well as the line chart, but we're still above the moving averages here. The momentum of the VIX still continues to be up as measured by the MACD. We're still seeing this for a second day now. The skew index is up in this red area where the market is expecting some kind of a big move. This could be some type of positioning before we get set to end the week, month, and quarter for June. And we don't know if this is going to be an up move or a down move, but the market is expecting something according to this. We did tick up a little bit here with the one-day equity put call ratio, but we're still going down with the 5-day chart. But we're still pretty high here when we look at the volatility risk premium. We're near all-time highs with the S&P, and this is continuing to go up. Usually we see it different than that. Quite often, not always. This is a separate indicator than the VIX, but this is just something that we keep an eye on, showing that there's a lot of volatility risk premium right now. And we're seeing a little bit of contradiction here. We ticked up slightly with this fear gauge where I guess this is not contradiction. We ticked up with this other, I'm so used to these going in the opposite direction. And with the advanced decline line studies here, we declined on an up day based on price. We still have not been able to break out above this previous high, and that is a negative divergence. That's the negative side. The positive side is we're still holding up fairly well when we look at the advanced decline line based on volume. Then we did see a contraction of the new highs, not really much of an expansion of the new lows. We're trying to turn up here with our 5 period and kind of leveling out after rising with our 10 period. And we were looking more positive here with our advanced decline ratio. Well, now we're coming down, even though it was an up day, but we're still positive here. And accumulation distribution, after coming down for a few days, is now starting to turn up, and it's above the advancing moving average. This is a smart money indicator, and this is encouraging for what we're seeing. Also ticking back up slightly with the Chaikin money flow. We want to get above the moving average and see the red line turn up to be more positive. And we're still declining here, though, with the Chaikin oscillator. And we saw some weakness in the broader market with the NYSE cumulative advanced decline line. It dropped below its moving average. We're still above the moving average with our regular NYSE advanced decline line. So that's holding up a bit better for now. Also holding up a little bit better with our regular NYSE advanced decline line here. And we came down with the common stock for the advanced decline line on the NYSE and also declined based on volume. So we didn't see an awful lot of broad market strength. When we look at the S&P, we are showing some slight improvement here with the cumulative advanced decline line based on price, holding up better still based on volume, and that is still more encouraging. With the NYSE advanced decline line compared to the S&P, we were showing an improvement. We came right up to this moving average, and now we have come back down. So when we look at our advanced decline line studies, after coming back up to the moving average, we're declining again with NYSE common stock. We did decline on an up day with the S&P, but we're still above the moving average, where we're declining with the mid caps after coming up to the moving average, and now declining again under the moving average with the small caps. So in our daily chart, we're just kind of chopping sideways for the time being. We will be watching these pivot points, either what we're seeing right now or previous pivot points, if some weakness starts to come into the market. Down below, we are still above average with volume. And we just ticked back up and are looking barely extreme positive with the Williams percent R. And we're turning back up in the short-term stochastics. We're still declining in the intermediate and long-term, but still extreme positive. Looking at our 20-period double and triple moving average study, exponential moving average study, coming down a little bit below these lines. We want this to go back up to be more positive. If this starts to break down and the lines roll over, of course, that would be more negative in the short term. And on an up day with the S&P, we declined with the 20, 50, and 200-period moving averages. We did come back up and we're positive with the force index. We're still above the 20-period moving averages. We're up in the upper side of the +2 channel for the standard deviations chart. So we're not extreme there. And we're declining here with the balance of power, but still positive. We're still positive with the go, no go with the darker blue bars. We're still just chopping sideways, but the highest high values hanging in there for right now. We're back to going up a little bit with the TTM squeeze after it looked like it had been leveling off. And we're still looking okay here in the intermediate term with our 50-period double and triple exponential moving averages. We have the red line above the blue. That means it's a stronger trend, and we're coming down. And so far, this area has been acting as support. We're declining, but still positive with the ease of movement. We're flat with the Arun indicator. And after we had turned positive, this is one of the internal measures that I was talking about. We had crossed back above zero over the last two trade, well, Friday and Monday, only to go back down below after Tuesday's session with the S&P 500 McClellan oscillator. So that means our summation index based on price, instead of going up, is now starting to level off and could be beginning to decline again, where we're still declining after coming down. We're slowing down with the decline based on volume, but it's still going down. And we're back to negative now with the NYSE McClellan oscillator after we just barely got above zero. So we are declining with the summation index based on price and volume for the NYSE. We ticked down with the Swenlin trading oscillator, but we're still positive based on price. We also ticked down based on volume and seeing a little bit of a lag here with volume. With our momentum studies, we're rolling over, but still positive with the PMO. We're actually crossing back over positive when we break this out based on price. We're still going down and not really showing much improvement based on volume. So with the PMOs that are rising, after it had been going back up, now we saw a decline. The buy signals are barely continuing to go up, and we actually declined a little bit with the PMOs that are above zero. And we continue to be neutral with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR, and we're leveling out here with the slope oscillator. When we get above the green line, you could say maybe that's a little extreme, but for right now, it still continues to be positive. And the MACD is rolling over, but still above its moving average. So all of our oscillators are showing some weakness now, but they're still above all of their various moving averages. And we're above all the plotted moving averages here. And this is still encouraging, though. We're seeing a little bit more of a tick up with the bullish percent index. We've been seeing that over the last couple of sessions. We're positive since we're above 50. Now, we're not showing any real strength here, but the fact that this has gone up the last couple of days is encouraging. We just need to see more follow through. And we're kind of just chopping around and slightly declining with the NYSE bullish percent index. We did tick up just a little bit with the NASDAQ 100 bullish percent index. And we're still declining here with the money flow. We're still positive too, but we did turn back up just a little bit. And we're flattening out after declining with the ultimate oscillator. The vortex is still positive, but we've been coming down with the green line where it had been showing some improvement. And we're not extreme with the RSI 14, but we have just barely climbed above 70 with the RSI 9. So that's extreme positive. We ticked up a little bit and we're above the advancing moving average with on balance volume. And this is another area. The 20-period moving averages of those stocks inside the S&P, we're showing some real improvement. We have an update with the S&P and this goes down. Now we're still above 50, but it's a bit discouraging to see this going down. And with our study, we were showing some improvement here, but now we're falling back again. And it's that same thing with the 50-period moving average study. We declined, but we're still positive. And same thing here with the 100. We declined, but still above 50. And we declined with the 200-period moving average study. So we were getting, at least I was, getting some encouragement from seeing some improvement here. But then we have an update with the S&P, and these indicators start to show some weakness again. The Copic curve is still positive, even though it's rolling over slightly, and we're still getting a buy signal from the Pring bottom fisher, which is strange. And we're no longer extreme with the Sean trend meter. It finally ticked down just enough to get out of that really extreme reading. And we're looking a little more negative here with our 5-period moving average of the highs minus the lows across the broad market. We're still coming in negative with that. And here's our weekly chart. We're just barely above this R2 level. Now, this could be longer term positive. So far, this level is holding for the time being, but we still have a few trading days left. We want to see if we can get above this and then close above it on the weekly chart. This is a new chart, and this is from the Tasty Trade platform because Stock Charts doesn't really have really useful tools. This is a thing called Fibonacci extensions, where especially in 2022, and as we were bouncing all over the place, you would see me show a lot of Fibonacci retracement charts. And that's when we have a low and then a high, and then we say, okay, how far back are we going to fall? And then there's different retracement levels, and that's quite handy. One thing that I'm a little suspicious of this, because I had a real bad experience with this about 20 years ago. I bought some software that was supposed to do all this automatically, and it really, once things changed, all the charts redrew, and I had a whole different picture that was being told to me. And it's really hard to make decisions that way because you don't know how it's going to adjust and suddenly morph into something new. The takeaway from this, I went to the low that we set back in October. Now, technically, I have a problem with this chart because I'm coming to the high that we set right at the end of March. Well, we set a higher high than that back in May, but this one seems to be lining up with where we're at right now, where we're coming up, and this could be acting as overhead resistance. Now, another thing to be aware of, this is lining up with some of the pivot points that we also see. So we can use this as confirmation with those other charts. So that's why it looks different. I use a different background on this particular platform. And I have another one to show you later of the cues. Well, we're still kind of just chopping more or less sideways with a lot of doji looking candles with the Heiken Ashi. The Kigi chart is positive, but pointing down. We're still positive with the Renko, and we're positive with the 3-line break. And we're coming down just a little bit here with our 150 and not extreme, but we are still seeing this longer term negative divergence. Also seeing that same negative divergence with the 200, and we're just barely above the 350 level. That's where I have the red line in here. So that's why we're extreme positive. And we are negative with the mid caps in the short term. We're negative with the small caps in the short and intermediate term. We're still just negative with bonds in the long term based on price. No changes with the decision point scorecard. And we saw some red, a little bit of blue along the way, where we had the tech actually have a MACD crossover sign. That was right after the open. But then the NASDAQ started to go up, and then it started to go down, and then it started to go up again. And the Dow dropped below 39,000. And the area that had been weak over the last couple of sessions, well, these were the strong areas. We had tech and communication. These are the areas that are really carrying the market right now. We would like discretionary to do better, but it's just not. And then some of the areas that had been stronger now saw some profit taking in these particular sectors. And we're looking barely negative here. When we take the NYSE new highs minus the new lows, we're coming in at -2, but we're still positive with the 50-period exponential moving average that's placed on top of this. And the equal weight is starting to underperform the mega caps now. So that's why we're seeing this ratio going back up when we compare the two. The Dow, after having a couple of good days and looking all right, then we were down about 0.75%, but we're still above the 50-day moving average, and we're still above this pivot point. And we've gone from being positive with the Elders Impulse system to neutral now with the diamonds. And the NASDAQ, this is the pivot point I've been talking about. We came right up to this level. We hit it a couple of times. And even though we were up 1.25%, we want to get back above this to actually turn more positive on the NASDAQ. And pretty much that same thing here. Even though we got a little bit above this pivot point with the NASDAQ 100, it would turn more positive if we actually come back and break above these previous highs. And we continue to be neutral with the Qs when looking at the Elders Impulse system. We're seeing a bit of weakness here with the NASDAQ 100 momentum. We're still above the moving average, but we are rolling over, and we're still going up when we look at the moving average itself. We need to see some follow through here to turn back positive with the momentum, or it's in danger of switching over negative. Here's another fib extensions chart for the QQQs, where we came just about up to this level, and now we've been pulling back. And I measured this from the October low up to the May high that was set right here. That one seemed to work. See, one of my problems with this is you kind of have to play around with this and come up with charts that make sense. And that I don't like to do that necessarily, because now I'm interjecting my thoughts into what's actually happening. The reason why I wanted to show these charts is it's also lining up with the pivot points that we're seeing. Not exactly, but they're in the same general area. And we're keeping an eye on the weekly chart of the Qs, because this is still looking a little bit scary. Not as scary as it was after Monday when we saw the decline, but to come up and then close just about where we opened for the week, because we were unchanged last week with the NASDAQ 100. And then to see it decline here, that could be negative. But we still have 3 trading days left to see if this can be taken care of. Small caps were down 0.85% and below their 50-day moving average, and they still continue to be neutral with the Elders Impulse system. We look at the small cap, the Russell 2000 small cap index, we're still below 50 with the RSI. We're below the 50-day moving average. The momentum continues to be negative. And the mid caps, after giving us a little bit of hope, getting above its 50-day moving average, now has fallen back below its 50-day moving average. This is another area I was watching to see possibly some internal strength was starting to come in. Well, we seem to have lost that, at least for right now. And we've actually switched over to negative with the Elders Impulse system for the mid caps. We look at the total US stock ETF, we are just coming off of recent all-time highs. So on a total market basis, we're still holding up for right now. Apple was up 0.45%, and we do have a relatively new established uptrend with a golden cross. Tesla was up 2.61%, but still in a downtrend. And we saw a little bit of a bounce after everyone was freaking out about NVIDIA. It's like, it's going up, and now profit taking. This is the end of the world. Well, it was up 6.76%. And in a stock like this, to see some profit taking, especially if you got in at these much lower levels, you're probably pretty happy right now. But it did go back up on Tuesday. Microsoft coming in here and setting a new all-time high and looking pretty solid. Meta, not back to an all-time high, but was up 2.34%. Amazon was up 0.41% and kind of just not really breaking out, at least yet. Google also setting an all-time high, up 2.68%. Netflix was up 0.5%, but still not really breaking out. The FANG index did bounce back up after it had been seeing some weakness over the last few sessions. The financial sector was down 0.75%, but we're still above the 50-day moving average. And we're going back down a little bit here with our staples to tech ratio, which is what we want to see to be more positive. The dollar was up and is in an uptrend. That could be pressuring stocks. And we're showing a little bit of an improvement still when we look at the S&P to the rest of the world. But the longer-term correlation continues to decline. And then looking at the staples sector, we were down 0.64%, but still above the 50-day moving average. And it's kind of strange here. Even though we were down, we're seeing a little bit of a turn up with the relative strength ratio as well as the momentum, but we're still below this 100. So that means it's more negative. And we continue to decline with the utilities. They were down 0.95%, still just about at their 50-day moving average. We're going down with the relative strength ratio, but we're starting to go back up with the momentum. And still declining here with the healthcare. These are the three big defensive areas that we've been keeping an eye on. And then looking at energy, which did bounce nicely off its 200-day moving average, but still has yet to clear its 50-day moving average. We're seeing a bit of an improvement with the momentum and relative strength ratio. And we did decline slightly with the 10-year yield. We were up based on price. And then looking at our growth to value ratios, a bit of a tick up after coming down to the moving average with the Qs to S&P. Discretionary to S&P, now it's falling back below the moving average, and a bit of a tick up when we compare large cap growth to large cap value. So the large caps are ticking back up, a little bit of a tick up in the mid caps, and we're ticking up, but still below the moving average with the small caps. We're still looking okay here, but we're getting really on thin ice. We're just barely positive with the advanced decline ratio based on price. We're looking a little bit better here based on volume. And we're going back up again with the S&P to utilities ratio, which is more positive for the S&P. And we're back to declining a little bit with the Staples S&P 500 ratio. We want to see this continue to decline to be more positive. So what's our outlook for Wednesday? We are still positive, but these negative divergences, which look like they were improving, they're just not going away for right now. And these internal and broad market, the strength that we saw coming in, we're just not seeing much follow through from that. We're going to get the MBNA mortgage applications index. I don't know what happened because last week on Wednesday, the market was closed and I don't remember seeing that coming out. We're going to get the new home sales as well. And then we want to keep an eye on all the crazy things in the world these days. Then we are going to get durable goods and GDP on Thursday. The big one is going to be the core PCE on Friday. And here's the new home sales. That's kind of the bigger one for Wednesday's session. Seasonally, we are looking neutral to negative with the Dow, where we're slightly negative there, but we're looking pretty positive for June 26th when we just break it out looking at the NASDAQ. We are in the week after options expiration, where we tend to be down slightly more than we are up. And Wednesday is the most negative day of the week based on what happened in 2023. Looking at our Stock Traders Almanac, we are on the 17th trading day of the month where we're coming down. And this could potentially be the end of this seasonality, negative seasonality that we've been going through. And then the last couple of days of the month tend to see positive seasonality. We'll see if that actually plays out that way. And this is what Carson is showing too. We're coming now into the 26th and 27th before we see a little bit of an up move for the last couple of trading days. Bigger picture, this is June in here, where this is a little bit of a downward move. I guess we'd be right about here. And before we tend to see more positive seasonality going into July. And we're still at the latter end of Tom Bowley's negative time here before we have a couple of days of things looking more positive going into the end of the month. And then I wanted to show July here. Just we don't have anything marked other than the 4th of July. The market will be closed for that day. And then another one, this is put out by Stock Traders Almanac, Christmas in July. It's the NASDAQ's 12-day mid-year rally going from 1985 to 2023. We do quite often see positive seasonality, which gets started right near the end of June and then goes into about maybe 2/3 of the way through July. You can maybe say halfway through July. So what are the warning signs? We're still keeping an eye on staples and utilities as well as energy and healthcare. The advanced decline lines, they're back to not really showing the strength that we thought we were seeing. The growth to value ratio, that is looking a little bit better, but it's not really leading at this point. And the discretionary to staples, it's not leading either right now. And the McClellan oscillators, yesterday this was on the positive side. Now I had to bring it back over to the negative side. The S&P and NYSE McClellan oscillators and summation index have now dropped back below zero, and they are declining. And the QQQ, we're just looking at that weekly chart to see if it continues to look scary or if we see signs of an improvement there. And then our positive signs, we're still positive with the parabolic SAR. Our smart money indicators are still looking pretty good. Chaikin oscillator is still declining, but overall they're still looking pretty solid. The equity put call ratio based on 5 periods is still going down. Our oscillators are positive, but they're rolling over a bit. And we're still above 50 with the bullish percent index for the S&P, and we're still ticking up. That's an encouraging sign. And the Swenlin trading oscillator, yeah, it ticked down a little bit, but it's still above zero, both based on price and volume. But we're seeing volume lagging a little bit there. The money flow, the ultimate oscillator, and the vortex, they are positive, but the vortex is declining after it had been looking more positive. The Copic curve is positive. The Pring bottom fisher, for some reason, is generating a buy signal. In the financial sector, we're still above that 50-day moving average. With the momentum of the NASDAQ 100, we're doing okay, but we could cross over and go negative with the momentum. And we're still above 50 with the NASDAQ 100 bullish percent index, but actually we ticked up just a little bit there. I think I might have got that one incorrect. So we are positive, but these negative divergences are still there. And in typical technical analysis, this is what we look for before major market tops, but we're just not seeing it yet based on price. And so for the time being, we still have a positive stance until proven otherwise. We can project and forecast and come up with all these scenarios all we want, but what's that going to do if the market still has more upside potential? Because there's other things that we've been watching lately too that are looking good for right now. And yeah, the world might fall apart 6 to 12 months from now. We might not even be here, but we can't do anything about that. The only thing we can do is evaluate where we're at right now and then try to say, okay, what's possibly going to happen the very next day? In the short term, we're just flat out positive there for the time being. It's the intermediate term where we're seeing a lot of the negative divergences and possibly some rotation going on, but it's not really clear as to what's happening there. And we are positive in the long term, but we're still extreme with the 200 period moving average study. And we're still seeing the negative divergences between the 150 and 200 moving average study compared to the price of the S&P. Thank you. I really hope you found this helpful. I really hope you have a good day, and I will talk to you in the next video.